Jim, it is good to meet you here, and good to we'll meet you in this space, and see you again. We're going to be doing a quick interview or an interview style recording here for everybody. Normally, we would do this as a live webcast, but we're finding that most folks are consuming this via recording anyway. So we thought we would just create more of a podcast style conversation and really get into some of your questions that we've seen here over the last few weeks. Now, I know many of you are very familiar with Jim and his work, but for those who aren't, just a quick backgrounder on Jim. He has a great wealth of both practical and academic experience. As an academic, he has a PhD in finance and industrial management from the York University, as well as was a professor at the Solich School of Business, as well as Bishop's University. And in terms of practical industry experience, he has a very deep base of that, having served in roles like chief market strategist, chief investment officer, as well as managing director for firms like Caldwell Securities, Wilmot Trust, as well as MB&T. And he currently works with us here as the chief wealth strategist for Wellington Altus Private Wealth. So I think Jim is very well known in the Twitter sphere for blending a style of analysis that blends together quantitative, fundamental, as well as historical analysis to deliver a view of the world at hand. So we're in a situation right now where I think a lot of folks, a lot of clients are feeling, look, there's sort of this confluence of the geopolitical, the economic, and the investment, and it's all coming together. And we're seeing a lot of questions from clients on that. And I noted your recent market insights piece for February touched on a lot of these things. Now, in reading through that, there's a few things I wanted to maybe start with here, is define a few terms before we get into a more general question. But there's a lot of terms you use in that piece, like Jacksonian pivot, Monroe Doctrine, Trump corollary, rules-based international order, as well as supply-side economics. And I thought it would be a good idea if we just maybe gave some background and talked about what those terms mean and what they currently look like. So I guess just starting with Jacksonian pivot, like what do those terms mean, Jim, in this situation?
Okay, so let's separate. Let's look at this in terms of who President Trump is in his cabinet. President Trump has defined himself as an America First type president, a populist. And so, you have a lot of people calling him Hitler, a Roman emperor, which has been a misclassification. When he identifies himself as America First or the American system, you instantaneously go back in time in history between the American Revolution and the First World War. And the economic policies that he is implementing is from Alexander Hamilton, Jackson, Abraham Lincoln, Monroe, Henry Clay, and it was a period of time when the Americans were developing their economic policies and theories to basically counter the British Empire. And, Alexander Hamilton came out with a very important book called The Report on Manufactures. So when you talk, I use Jackson as opposed to Alexander Hamilton, because that's really the period of time where in the 1800s, where the America First economic policies started to be implemented. And that meant tariffs, that meant immigration, stop the immigration, stop the Great Move West. Talking to folks in Calgary, that was stopped in the 1800s. And what Jackson also did is he attacked the first Federal Reserve, right? And remember, Conrad, the Federal Reserve that we have today, this is his third incarnation. So when I say Jacksonian pivot, it's really a head nod to everything that Trump and Bessent and Ludnick are doing is an economic policy based on what the U.S. did when they won the Revolutionary War in the 1800s. Okay, full stop. So this isn't about us. This isn't, so we got to stop the Trump derangement syndrome. So why did he have to do this? Well, look, the economic policies or the rules-based order, that would be, GATT, the World Trade Organization, the United Nations, that type of a system can no longer, the Americans can no longer support. They can no longer have a neoconservative military strategy where they send their militaries off to fight these wars. They can't afford to anymore, right? We talk about the fact that they have excessive levels of debt. So when you hear people say the rules-based order is another way of saying the economic order set after World War II is over. It's unsustainable, insofar that the Americans can no longer foot the bill. So they have to look inward and take care of their own backyard and their checking account. What was the forcing function? For me, Conrad, it's when we allowed the World Trade Organization, when the World Trade Organization allowed China into the World Trade Organization, where they supercharged urbanization in the United States, in China. But what they did is they hollowed out the manufacturing in Canada and the United States. And hence you had the rise of populism and the fall of the standard of living of the Western world. John Maynard Keynes warned everybody coming out of World War II at Bretton Woods that we would have to cross this bridge. So the Americans had to adjust. Their standard of living was stagnant. They weren't growing. They could not finance the endless wars and regime changes. They could not allow other countries to take aggressive, what we would call mercantilist trade policies against the United States. That's where we're at. And what we have to understand is it's not about us. We're just caught, like I said, we're in a crossfire hurricane, right? We are stuck in the middle between the Americans having to change and the Chinese, the two big countries that are fighting for supremacy. So that's where we are. And, we are starting to grind our way through that.
Right. So in your piece, you also talk about sort of a conflict between different economic doctrines. Could you maybe contrast, Keynes, I know you brought up Keynes, the economic doctrine that was promoted by Keynes versus the economic doctrine that you see, being implemented currently in the U.S. and some of the background of supply side economics and where it's been used in the past.
Okay, so I'm going to give you some backstory, right? Keynes's book is called The General Theory, and Keynes didn't want to call it The General Theory, but his publisher wanted it to be named The General Theory because he thought it would sell more books. And he was on his deathbed. He said to Hayek, actually, that if I can get healthy, I'm going to come out and basically say that. Keynes's work was really only designed for the Depression economy. And in the Depression economy, it was basically government spending is focused on demand, generating demand. So you push the demand curve out.
Right.
And so what we have done, or what has happened since the 2000s, is those economists that adhere to that point of view, right, look at economic policy as introducing policies that create aggregate demand. And when you do that, they think growth is bad because growth is inflationary. Okay? And that is the old regime. So when you hear Macklin talk or you hear Powell talk, that's how they're explaining, the economy's hot, therefore inflation is going to go up.
Right.
And so there is a different view that comes out of the University of Chicago or Milton Friedman, and it's the supply side, where you focus on economic policies that generate supply. It's really from a guy named John Baptiste Say. It's called Say's Law, that if you generate supply, demand will follow. Well, if you shift the supply curve out, prices go down and output goes out, and we have non-inflationary growth. That is the philosophy that Trump and Bessent and his new Fed chair Warsh are going to implement. And it really, in our lifetime, when we can say this happened, was in the 1980s when Ronald Reagan came into power, and one of his chief economic advisors was a gentleman named Robert Mundell, who was a Canadian.
Mm-hmm.
Right? So Trump is focused, if you think about it, Trump is focused on cutting taxes and deregulating and getting manufacturing back to the United States from China. That is shifting supply out. So therefore, growth can grow at 4% and prices continue to decline, which means the Fed will not raise rates when the economy gets strong because it's caused by the supply side, not the demand side. So when I say that to you, Conrad, what I'm thinking is we're in this new regime that we had between 1980 and 2000.
Mm-hmm.
That was basically the period of time, and we had a massive secular bull market. And the one sideshow I would say to you is this. We, as Canadians in the early 1980s, pushed back against this and elected Pierre Elliott Trudeau. And we basically embraced Keynesianism for 5 more years, and our standard of living dramatically fell. I want to add one thing from the last section that you asked me, but I didn't answer. Folks, in the 1800s, there was this gentleman named Monroe, and he came out with the Monroe Doctrine, and it was an explicit military statement, which basically said the European colonizers get out of the Western Hemisphere, it's ours. All right.
Mm-hmm.
Roosevelt in the 1900s added what was called the corollary to that was, if you come here, we will fight you militarily.
Right.
Trump, in his national security document that just was released, it's about 35 pages, it's very clear. He has what's called the Trump corollary, which is no factors of production or supply chains or ports will be owned, a majority ownership from a non-market based economy, China.
Mm-hmm. Right.
And that is their economic policy. And so what Trump has done is he has basically said economic sovereignty is a matter of national security, and we're willing to do whatever it takes to maintain that.
Right. And then would you say that China also takes that? Is this Trump unique in this, or does China explicitly also say that economic sovereignty is part of national security?
I would say China says exactly the same thing, but in their own way.
Right. Different
So
expressions,
this is
but
where
same
the rule,
idea.
yeah. So this is where we go to a thing what's called realpolitik, as opposed to a rules-based order, where before we'd all get together and do kumbaya, and now it's really those who have the power win, right? And that's where Carney, when his Carney's speech from the World Economic Forum, I think he's quoting Thucydides, where he says the strong do what they can, and the small suffer what they must. And folks,
Mhm.
we're small.
Right. So if we put these ideas together, I think, in sort of the first section here, just sort of wrapping this up, is that what we're seeing is not a rebirth of the Third Reich, with an American flag. What you're seeing is a rebirth of policies that existed between the Civil War and World War One that were designed to deal with another empire, air quotes, the British Empire. They're being reworked, retreaded, updated to deal with to deal with China.
Yes, and they have to change. This is the thing. With debt to GDP of 125% and deficit spending of 6 to 7% of GDP, there's no more kicking the can down the road, right? I mean, as Richard Nixon said, we'll deal with the deficit in the out years. Well, folks, we're in the out years. We have to deal with it right now. So there's no going back. And so we need to depersonalize this. We need to understand the Americans are changing their economic model. And what we need to do as Canadians is realize that, the most fastest dynamic economy in the world is south of us. And we need to figure out how we can be treated as an insider in that economy.
Right. So I think that's a good point to make. In your piece, you talk about, the fact is that there's two rule sets evolving, right? One is American, based on, the Trump corollary, which is, of course, that, market-based. We don't want to trade with non-market-based economies. We don't want to be trading with somebody that will sell at a loss to put our auto manufacturers out of business, for instance. And also the American rule-based system and the Chinese-based rule system. And I mean, if you think about things from a Canadian perspective, like, what are the ultimate implications of that? Is that we have to kind of make a choice, that we kind of got to be in one camp or another? Can we span the two camps? Really, like, where is that gonna leave us, given that both these great powers are doing the same thing in their own way?
I think we need to, when we cut it, I think one, this is a matter of national security for the United States. I think first off, they want to be ensured, the Americans, that if we are treated as inside the United States economic and security bubble, that China can't come in through the back door.
Mm-hmm.
And so that, what does that mean? That means regulatory, security, immigration, things need to be shored up. I mean, that's one. Two, I think what we need to understand is the benefits that we got, and really, it's funny. It really, the relationship that we got with the Americans really came out of a fight between John Diefenbaker and JFK, where after World War II, we started to push back on, for example, that was called the Bomark missiles, where during the Cuban Missile Crisis, the Americans wanted to put nuclear warheads in our north. And two, it was the Avro Arrow, which we took all of the folks that came over from World War II that came to Canada from Germany and the UK, and all the rocket technology, and we made this really good fighter jet. And we didn't do it with the Americans' blessing. And so, what that meant, and there is a great book by George Gross called The Lament of a Nation, the Loss of Canadian Sovereignty. That war, between the political war, was a statement that basically said, hey, look, you are not economically and security independent from the United States. And if you do that, and you give up the arrow, and you do what we say, we are going to, and this is where Paul Martin Sr. came in. He went down and negotiated the Auto Pact with then Vice President Lyndon Johnson at his ranch in Texas. And that developed our trade relationship. And, Conrad, we were making, I don't know, somewhere between, I think at the max, 3.5 to 4 million cars a year, right? That system now needs to be rejigged, and it will. Like, for example, our aerospace industry is treated when we bid on U.S. military contracts as a domestic. Our aerospace industry is inside the tent, which by definition means we're in the F-35. We make the arm for the Canadarm, we're there. So we have this industry that is there. We need to create an environment where every industry has that same type of capability to be able to go and compete in the most dynamic market in the world. That means we need to start giving up our non-tariff barriers.
Right.
That means to airlines, to telecommunications. That means, I'm not going to say, the Sankrosite that talk. What are we going to do with banks? That means agriculture. But Conrad, it also means, think about this, how are American companies and their products going to be treated up here in Canada when the Americans basically don't have a carbon tax? If an American product comes up here and it costs $3, Carney's not going to be able to put a carbon tax on that and sell it. That's a non-tariff barrier. That's what's going to happen, right? He knows this. And so that's kind of, we're in the way I frame it is we're in that period between 1957 and 1964 where we're clashing, where Kennedy and Diefenbaker were clashing heads about what this new system looks like. And unfortunately, and I mean this with respect to the politics up here, I know people get upset. I think Mark Carney understands that we have to go that way. I don't think Mr. Poilievre really understands that the Americans don't want us to have our economic sovereignty. And so hence the title about we're a colony, whether it's the UK, China, or the United States, that's who we are. And so let's develop an economic policy to, take advantage of, the natural resources that we have, all the gifts that we have, and go from there.
Right. Well, that certainly is that's certainly is a very realpolitik perspective. And, thank you for sharing that with us here, Jim. I'm just moving maybe on from the higher level now, sort of bringing things down a bit into some more nuts and bolts here. Right. You mentioned earlier that the U.S. administration is pivoting towards supply side economics. And I think that, that pivot, if we look at the data, we are seeing the U.S. economic growth pick up fairly rapidly. What should investors be doing now? Like, where should they be looking for opportunity? What type of new, does this open up a new opportunity set, or does it just make the existing one, reinforce the existing ones? Or what are you seeing in terms of what direction, what are the opportunities as we're looking out the windshield here?
By the end of the decade, it's going to become self-evident that the United States is the most dynamic economy of the world. And they are going to be growing really, really fast for a long period of time. And what investors need to do is to get access to that wave. And so, right. When I talk to you, Conrad, I say, I don't care what sector it is, you got to get in there because they are rebuilding their economy. They are moving forward at light speed. We need to make sure that as Canadians, with your portfolio, you need to get access to the right areas of the economy. And as a country, we need to get access for our companies to get in there, because U.S. is going to be growing at 4, 5, 6%. We're going to barely grow at all.
Right.
So that
we
would
obviously
be
have to look to diversify into those sectors that are heavily represented in the rebuilding, the rebirth of U.S. manufacturing, the rebuild of infrastructure, as we're seeing, whether it's data center or just physically building power lines and bridges.
Yes, and
that's what we mean by that. That's what this sort of supply side.
Yes, and we didn't even really chat on the other massive theme, which is the technology wave, which is AI.
That's right.
right?
We have spent a lot of time talking about that, and I actually do want to get to that here in a second, because one of the questions I do see coming up in my conversations here is, is whether the Mag 7, that AI trade has become the Lag 7, right? And whether this is just a pause that refreshes to give a chance for these CapEx, these build outs to happen and prove that they work, or is that trade, is that now a dead idea and we have to move on to something else? But what's your view there on the way that that's evolving?
So as we said about the Americans, that they have no choice but to change. AI is forcing technology companies and companies in every sector that need to change.
Right.
And in what is different, Conrad, about this cycle, I was just talking to an interview in New York about then the last cycle in the 90s, is what we know is that companies that do not innovate and are leading edge, they will be disintermediated. They will go away. So what's different from this cycle from the 90s is the fact that front and center with these tech giants is the fact that if they don't innovate to get and become a leader in AI, their business model ceases to exist. In economics, it's the prisoner's dilemma, right? What does that mean? That means they are going to spend more than makes Wall Street comfortable, right? Okay, so think about that. So that's one, and everybody's going, woo, right? Okay. Two, everybody before Trump got in was expecting the United States to have a muddle through economy, which meant that you wanted, when you were building your portfolios, you wanted to have exposure to secular growth, which are areas within the economy that aren't tied to the acceleration of GDP. They're not cyclical.
Exactly.
So you have a positioning, so you can see where I'm coming here. You have a positioning of the book of the investors in, let's say, North America or the Western world that is overweight Mag 7. One. Two, they are all worried that they're spending too much on CapEx because, pardon me, Trump has made their tax deductibility of CapEx 100%. Okay? So you've got this period, I call it the Great Rotation, the rotation out of Mag 7. And it is going to be short-lived, which in our world, short-lived is maybe it's a couple of quarters, maybe it's to the end of the year, where people sell down the Mag 7. Now, that doesn't mean they don't own them, Conrad. That means they take it from a position of 7% to 3%. And they take that capital and they go to this other area of the US economy that is experiencing the deregulation from Trump and Bissett and that supply side revolution. Right. So that's where we're at. And so, the pause that refreshes is there. It will be there. That's where when I write and you see the breadth is going to broaden and you need to be in other areas of the market. So hypothetical, a year and a half ago, or coming out of the global financial crisis, you would have 80% of your portfolio in what we would call secular growth names, because the economic policies that were being implemented at the time were not dealing with the slow growth environment. They were the Keynesian guys that were they misdiagnosed it and they're putting the wrong policies in place. Now we got guys that are saying, we're going to run this thing hot and we're going to get a guy in the Fed that's not going to raise rates when we run things hot. And we're going to grow our way out of the debt and we're going to have an era of strong growth. Well, if that's the case, maybe you don't want 70% of your portfolio in Mag 7 or in tech. You want 30%. And so it's more of the lack of or the overemphasis of Mag 7 previously because of the slow growth economy that I think right now people are really starting to understand that this is really happening.
Definitely seems like, there has been a significant rotation. And in this, what you'd be speaking of here is like, again, you'd want to make sure that your portfolio has, and above, you want to make sure it has a weight to things like industrials, right? Industrial machinery. You want to make sure your portfolio has a weight to things like energy. Your portfolio has a weight to things like transportation. You've got to move all this stuff, right? If Amazon is going to spend $200 billion on data centers, right, because of that ability to deduct, then you want to own all of the stuff that makes the stuff.
Yes, and I think, we've talked about this. Your positioning in tech must be much more nuanced.
Absolutely.
And I think, which means you need to understand that it's those companies that rightly or wrongly buy those areas in technology that are benefiting from the excessive capex. So those aren't the companies that are spending like drunken sailors. And then the last thing so that would be semiconductors, memory, hard drives, fiber optics, anything inside those data centers you want. And then the other thing that you would want to position for is the fact that ask yourself this simple question. What areas of the economy are going to benefit from AI and become more efficient with AI? And what companies are going to be disintermediated by AI? And right now, Conrad, that's software, which is, when you think about it, software was, 2 decades ago everybody went into it because what did software do? Made our businesses more efficient. Well, we've got something that's better than software. So what is happening there is software companies, let's say we did a 10-year DCF for a software company, that's a discounted cash flow. People are all saying, whoa, 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 whoa. It's not 10 years. Maybe the earnings are good for the next 2 years, but we're not going to give this a premium valuation because we don't know what this thing looks like in 10 years. So now you've got people sitting and delineating between benefits of AI that would increase productivity. That's why, Conrad, I say banks are going to be huge beneficiaries of AI. Our business is going to be huge beneficiaries. And then a CRM company or a software company, maybe we don't need as many seats. You know what I mean? Maybe we don't need as many licenses. That's what we're dealing with right now.
Absolutely. Well, in running my business, we can have internal agents inside of the secure environment. Maybe we don't need to hire another assistant, right? For example, right? Or if you're Goldman Sachs, you can remove a lot of your back office functions and save a lot of money and really increase your profit margins. So,
and that's where those companies' margins or EBITDA margins go through the roof. And then we start think about pricing Goldman Sachs at its software multiple.
Exactly. That is a lot of upside from here potentially.
Yes.
Now using this idea here of using AI to have beneficiaries, I wanted to talk about blockchain technology here. We know that obviously is pivotal, and that all the major U.S. financial institutions are very, very busy in that space, adopting technology, creating stable coins. I know we've talked about this before on different conversations. What is how do you see the role of blockchain evolving? And I would also say, how is the narrative, especially with this, the new wave of, Bitcoin is now worthless or Ether is now worthless? How do you view that, really what is going on the ground versus the narrative, and how are those two really diverging at this point?
Wall Street is going to embrace this technology. It is the biggest innovation in accounting since zero was brought back from Asia to Florence, Italy, and the Medici family invented double entry bookkeeping and accounting. And
Mhm.
what blockchain does is it allows you to do record keeping, and you don't have to reconcile. And remember, the thing about what the Medicis did is that eliminated the abacus in trade. And it was a fantastic, I mean, go back in time and look at that. It's crazy. But what I would say to you is, if you have an accounting system that doesn't need to be reconciled, you have a smaller accounting department. If you do a trade that goes on a ledger that everybody sees that hasn't been hacked, that can't get hacked, well, then you can do trade as settlement. That means you don't have to have as much capital exposed. So they are implementing it. It is going to be implemented. The Americans it is a matter of national security to be leaders in AI and crypto.
Mhm.
So these folks that come on and say crypto's going to zero I would just say, are being silly. And I look at this pullback in crypto. Now, I'm going to be specific. Ethereum and Bitcoin have been identified as winners, right? I think a lot of the other stuff is junk. Okay,
Yes.
that's fine. But two, what is going on? And it's a big question. Because ever since this developed, when you go down the rabbit hole, is the industry that gets disintermediated from this is banking. Think about this: the Medicis. What was Florence, Italy? Right? Think what happened with the bankers in Venice? I mean, Marco Polo. I mean, they financed the wars, right? With the new technology, right? So there is right now discussions on what are the rules of engagement. And so what blockchain allows you to do is allows you to send money or value across the internet, and it's not replicated. It's eliminated what's called the double spend problem. Well, I don't know if for the folks that are listening, have you ever tried to bring 10 grand up from the United States to Calgary? They hold it for days. They charge you, blah, blah, blah. Right? I mean, when El Salvador gave everybody a digital wallet and became a true Bitcoin or blockchain economy, 1/3 of their GDP was remittance from family members working in California. And if they sent that through Western, like FedEx or any of these wires, right? Wells Fargo,
Like Western Union.
The average size would be about $200, and $60 of that would go to wire transfer fees. You could transfer money on pennies on the dollar. That destroyed Western Union's business. That's how powerful. That's why you would expect the status quo to push back. Now the discussion is, look, and this is not a new fight. Banks have always been really scared about losing their checking and savings account. Banks have always been scared that Jim and Conrad leave too much money at the bank, earning no interest, so that they can lend it out on fractional banking. That's what they do. That's their profit. When the mutual fund industry came along, they all purchase mutual funds so that they could have a money market fund, so that if Conrad shifted $25,000 out of his checking account into the Kluge money market fund, the Kluge bank still had control of that capital. Well, what's happened now is we're coming out with stable coins, which is basically a new blockchain rail for the global payment system. We are rewiring the global payment system that was developed in the 60s and the 70s, and it's going to be blockchain. Some of these folks on the crypto side want to be able to charge excessive amounts of interest for these stable coins. Or think of it, they want to be able to charge excessive interest or give you excessive interest on a money market fund. So instead of you giving your money to Kluge and he's giving you 2%, I'll give you 8%. You sit there and go, shut the front door. I'm going to give my money to Thorne stablecoin. Conrad Kluge's fractional bank loses reserves and the whole banking system collapses. That's the argument that's going on right now in Washington that will be settled. And I would suggest to you that what will happen is cooler heads will prevail, and the crypto bros will understand that they're not going to disintermediate the fractional banking system. They will be able to charge an interest or a reward, they're calling it, equal or equivalent to the money market funds you would get at a bank, and everybody will live and have a happy day. And when that happens, trillions and trillions of dollars will flow into Ether and Bitcoin. And we will be looking at ourselves, Conrad, going, why didn't I take my line of credit and just buy everything? But that is the evolutionary process. It's everybody's talked about it. It's happening. And so if it's right for you, when I talk to Conrad, I say yes, but it's an infant asset class. And so we go through what happens when you invest in an infant asset class. We get periods of silliness like this. And if you've done your work, you dollar cost average, and you realize that this is a wonderful time to buy, and recognize the fact that it's going to get silly on the upside. And that's okay. And the last thing I would say to you, Conrad, I think it's at 65 or 70,000 somewhere today. I don't know exactly, but they're saying it's going to zero when it's 65,000 US or 70,000 US. They said the same thing at 2,000. They said the same thing at 200. This thing's going to go up, and then it's going to correct again. And people are going to come out and say, you know what? It's going to zero, but they're going to do it at 150,000. So what I would suggest is it's not going away. And the line I say is everybody buys Bitcoin at the price they deserve, which means the price where they finally educate themselves and they get to the point where they stop ignoring the noise that's on mainstream media.
Right. That's a great way to wrap up. I mean, Jim, I'd really like to thank you for the time you took here to have this conversation with us and sort of build this picture out, and as well as touch on some specific topics. I mean, we'll have you back later in the year, and would always just say to each and every client or individual whoever's watching this, again, questions on this, please reach out to myself or the team, any means possible, email, phone call, smoke signal. We want to communicate with you on your terms when you're ready. And again, we'll wrap this up. And Jim, once again, thank you so much, and we'll have you back.